You increased your household income estimate within covered California and your health insurance subsidies dramatically dropped or went away. What's going on? Hello, I'm Kevin Canals, a certified health insurance agent with Covered California. And when some of my clients call to increase their income estimate within the Covered California application, they are shocked and surprised at how the rates have increased on a monthly level because their subsidy decreased. There are two issues going on here. First, as your income goes up, the consumer responsibility percentage that you must pay for your health insurance also increases. So you have to pay more for the health insurance. Subsidies go down. In addition, the exchange, Covered California or healthcare.gov, must also consider the subsidies that have been paid out on your behalf and reduce any future subsidies by that amount because you may have been receiving very large subsidies at a lower income. That's a lot of math. So let's look at an illustration to try and help you understand what's going on. Sandy and Tom live in Grass Valley, California, Nevada County, Northern California. They're both aged 40. They entered Covered California for January 2023 with an income estimate of $30,000. At that amount, those ages, they were determined that they were eligible for a monthly subsidy of $1,238. They selected the Blue Shield Silver PPO Silver 87 plan, and that also happened to be the second lowest cost silver plan, which can be important. So the subsidy of $1,238 was deducted from the full rate of $1,254, and Sandy and Tom were paying a little over $15 for their health insurance every month. Now, it is important to note that at $30,000, not only were Sandy and Tom eligible for that enhanced silver plan, Silver 87 with the lower cost sharing, their consumer responsibility was 0.88%. That means under the ACA calculations, they should only pay 0.88% of their household income for the second lowest cost silver plan offered to them in their area. In June, Tom gets an increase in his wages, and we need to adjust the income. And so here is a graph of how this consumer responsibility changes. And what they do is they take the income and compare it to the federal poverty level. At $30,000, they were at about 170% of the federal poverty level, which gave them a consumer responsibility of 0.88%. But now, at $60,000, they're at about 344% of the federal poverty level, and you can see that the consumer responsibility is now at 7.1% of the household income. So much higher percentage that they must pay towards their health insurance. Sandy and Tom go to the Covered California Shop and Compare tool to get kind of a feel for how much their subsidies may decrease and their health insurance increase. One of the first things they notice is they're no longer eligible for a Silver 87, they're in a Silver 70. And at that higher income, the monthly subsidy is guesstimated to be $917 with a monthly premium of $336. However, that is not the case, and I'll show you why. Sandy and Tom, they received the income increase in June, so we were making a change for July 1. For January through June, they were receiving a monthly subsidy based on that lower income of $1,238 for a total of $7,432 that Covered California had paid to their health insurance carrier on their behalf. Now, we have to remember that these health insurance subsidies, what the exchange is doing is they're calculating the annual amount and then they chop it up into 12 little increments and forward that to the health insurance carriers. So it's all really based on an annual amount and then divided up by the months. So when we actually go into Sandy and Tom's account, the annual subsidy at $60,000 is only $11,015. Covered California must subtract what has already been paid to them at that lower income, which was $7,432 for those 6 months. They subtract that from the $11,000, and there is a remaining subsidy of $3,583 left to distribute to them. So Covered California takes that $3,583, divides it by 6, because there's 6 remaining months, July through December, and the monthly subsidy is now $597 per month. So when we actually put all that in and push the button, their monthly subsidy is $597. The premium is still the same for the Blue Shield Silver 70 at $1,254, but their monthly premium that they must pay to Blue Shield is $657. It went from $16 a month to $657. It seems dramatic, but it's true, because Sandy and Tom had already received a large portion of the subsidy they are eligible for at $60,000. Now, all of this math and calculations by the exchanges is to make sure that when a household does their taxes, they have not received too much subsidy that they have to repay, because we all hate repaying taxes. We hate paying anything to the IRS. So this is the way to make sure that if Sandy and Tom file their taxes and it's $60,000, that they will neither owe any excess subsidy back to the federal government, and they will not receive a bunch of money back from the federal government. Of course, it could be worse. In June, it could be that Tom was moving to Southern California to begin a job in July with that higher income amount. And as I mentioned earlier, this consumer percentage and the subsidies is all tied to the second lowest cost silver plan. Health insurance is less expensive in Southern California, and there's a lot more carriers. So here's kind of an illustration that kind of shows you how it might work if you go into a situation like that. So from January to June, when Sandy and Tom were living in Northern California with a $60,000 income, they were eligible for $917 per month, or a total of $5,507. When they moved to Southern California with lower health insurance rates, a lower second cost silver plan, they're only eligible for $370 per month. That's the same 7.1% consumer responsibility for a total of $2,224. You add those together, and so at $60,000 between the two regions of California, they were eligible for a subsidy of $7,732. We subtract what they had already received in Northern California with a lower income, and that was $74.32. So the remaining subsidy to be distributed to Sandy and Tom is $299.94. Covered California takes that and divides it by 6, because there's 6 remaining months in the year, and their monthly subsidy is $49.99. If Sandy and Tom want to keep that Blue Shield Silver 70 plan, even though the full monthly rate is less in Southern California than it is in Northern California, they're only getting $50 to lower the amount, so now their health insurance premium is $1,136. So Sandy and Tom would probably want to look at switching carriers to lower their health insurance premiums for the remainder of the year. It can be very confusing when you go to change your income and make a slight increase or you move to a different region of California and your subsidies suddenly plummet. But it is all set up to make sure that no one has to repay a large subsidy amount, excess subsidy, back to the federal government when they file their taxes. So there's probably a lot of questions. You can leave those and other comments down below in this video. You can go to my contact page on my website and get a hold of me that way, and I will do my best to answer these complicated questions. So for insuremekevin.com, I'm Kevin Knauth.